Thank you very much. No problem at all, and I appreciate the introduction, the opportunity to speak. Certainly, real estate as an investment class, as compared to those who have come before me this morning, is boring, relatively. It's not new technology. It's not exciting. It's an asset class that's similar to a warm egg sandwich. It's tangible. It's what people want. It's what people love. It's what people care to have. And it's one of the things, because of the laws in the federal laws since 1933 and 1934, the Securities and Exchange Act, really made it impossible for millions of qualified investors to be able to own great real estate. And real estate, unlike other asset classes, is management intensive, and therefore most people who want it and want to feel something tangible in a world where non-tangible assets can disappear overnight or lose value. It's really an asset class that has endured for centuries, long before America became America. And so I'm here today to discuss our company and the investment opportunities we've created since 2013, since the law changed in the U.S. securities laws changed under Regulation D 506C, which for the first time since 1934 allows us to market the opportunity to own real estate in Los Angeles, in the West Side. We're calling in from Malibu, California, across the street from some of the wealthiest population demographically in the world and some of the most expensive real estate in the world. So this was never accessible before because we couldn't tell anybody about it. Under the law, you could not market as a security, a real estate security, without it being registered. And under the Jobs Act, which was passed during the Obama administration, and since has been law since 2013, the greatest aspect of that change was the ability to market the opportunity to invest with us in all 50 states. So I'm going to roll into, besides what I think most people understand about real estate and its tangible quality, but single most important thing times three is location, location, location. Real estate valuation is completely focused on where it is, not what it is, not what it does, not what the future looks like, but it's got to be great location. And so why Los Angeles? Well, Los Angeles is, for people who don't live in this area or who are not familiar with it, it doesn't have a central city core. It didn't grow as other cities have grown in the United States, with a central city core and everything being surrounded by it. The West Side region of Los Angeles, which is the closest to the coastline, consists of 5 different cities, and every city has its own set of regulations and development requirements and restrictions. And essentially, it's the most in-demand location, if not in California, certainly in the United States, and perhaps in the world, because we have the best year-round climate, and yet we're in a country that doesn't put an owner of real estate at risk from having the real estate taken from the government. I mean, we have a stable form of government, and historically, money comes in from all over the world to invest in the United States. And since the growth of China in the last 40 years, and particularly in the last 20 years, and because our ports are closest to the Far East and Asia and China, we're just beyond explosive in terms of the demand and the difference between demand and supply. So we're very, very focused in this market. We've never left the west side of Los Angeles. So the question is, why do it now? Well, it's never a bad time to buy good real estate. It happens to be a situation where there are better times and worse times, never a bad time. And right now, largely because of 2 things, COVID and COVID. Here's the negative of COVID, okay? The negative of COVID is buildings are empty, tenants aren't paying rent, landlords aren't paying their mortgages, and the world has changed. and the stay-at-home or work-from-home concept is going to have a material effect as we go forward. On the other hand, the good thing about COVID-19 is the CARES Act that was passed this year in response to COVID, which has created incredibly more beneficial tax benefits for owners of real estate than even existed prior to the COVID pandemic, and we expect more to come. So what we're seeing now and the expected changes in the estate tax laws coming in the Biden administration in 2021, 2022, we're finally seeing a lot of owners who never would sell their real estate to cut loose. And particularly in an environment where we can buy real estate at a discount from sellers that need to sell and want to sell, to be able to lock in the tax benefits that are available today that might disappear tomorrow. We also have lower interest rates than we've seen ever, historically ever, and money is still available. So you combine all of those factors and you say, we've already got location, 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 and we are in the best markets, best real estate climate, best markets in the country. It couldn't be better. But like I said, it's never bad. It just happens to be attractive and getting more attractive. So after 43 years of operation exclusively in the West Side region of Los Angeles, these are areas that are worldwide known: Beverly Hills, Century City, West Hollywood, Santa Monica, Malibu, Venice, Silicon Beach, Playa del Rey, Marina del Rey. It's just endless. And these are locations that are known all over the world, where I've traveled all over the world. And if I tell people where I'm from, they go, Malibu, California. Oh my God, you're so lucky. Or Beverly Hills, or the Hollywood sign. These are iconic things. And they're iconic not just because they're worldwide recognized, they're iconic because it's where people want to be. So when you combine that with the ever-increasing demand from the entertainment industry, from the tourism industry, from the import-export business, and now technology, as we're stealing more and more business away from Silicon Valley and moving it down to Silicon Beach, where the weather is better year-round and the rents are cheaper, there's just a continuation. And why Christina? Because this is our playground, and this is the market that we know and that we operate in, and we know every square inch of the West Side, and we know what we can and cannot buy and why, and we don't need to sit here and do a detailed 10-year cash flow projection or build a model to figure out where it's going to go. For the last 43 years, it's only gone one way, up. And so, this is something that we particularly are known and famous for, and excited to be able to bring it out to a broader audience legally, whereas we could not have done so before under the restrictions prior to 2013. So, a lot of things that real estate provides that other investment classes don't, which are tremendous tax benefits. It came as a surprise to Congress, not really, but to many Congress members and the American public, that Donald Trump only paid $750 in taxes on who knows how many millions of income. The one that was really surprised is Donald Trump. The fact that he even had to pay $750 has probably pissed him off more than losing the election. And that's the whole thing about real estate. And this is a lot of people don't understand. Beyond the tangibility of just owning real estate, the laws that have been in place for years, which allow buildings that you buy that you think are going to go up in value, but for tax purposes, they depreciate, which means they lose value every year. And those losses taken against your income from the real estate, whether it's from a sale on a gain when you make a profit, or whether it's profits that you earn from operations, you never really pay tax because you use the depreciation and amortization to offset your income. And finally, you can infinitely refinance real estate and extract capital and never pay tax because loan proceeds are not taxable. Now, that only works if you buy the real estate right, manage it effectively, own it in the right locations, and have the ability to access those debt markets to be able to capitalize on the benefits that the government gives you. That's what you need. Most people can't get it. That's what we do. That's what makes us a great sponsor, and everybody needs a sponsor. So our Christina IV offering, which is the fourth in a series of private equity real estate companies that we have been offering since 2014, is still open for investment. It's nearly fully committed. And the structure and the strategy is quite simple. You know, we have these private equity companies that own a defined number of buildings, and because there's a defined number of buildings, it's a closed-end company. Once it owns its properties, it's mining them for its upside potential, its income, and its tax credits, so to speak, or its tax losses. And so when an investor invests in Christina IV, a private equity company, and if they invest 5% of the total capitalization, which this is a $50 million capitalization, so it would be $2.5 million, you own 5% of the buildings that are in the portfolio. So since our first closing on July 1st, 2019, our first initial closing on capital, we've so far acquired 6 properties, 4 in one portfolio, which is the West 3rd Street Shopping District, which is adjacent to CBS Television City, the world-famous Grove Shopping Center and Farmers Market, and walking distance to the Beverly Center, Cedars-Sinai Medical Center, which is on par with some of the most exclusive medical centers in the world. And it's a fully developed, highest demographic count in the west side of Los Angeles, and the highest demographic count in the entire Los Angeles region. We bought these 4 properties called the Hayworths from a single family that developed them starting in 1959. They'd never been sold. They'd never been marketed. I just happened to know the family. And then the most recent acquisition is this property that we purchased on the beach in Playa del Rey. We bought that from the original owner, who's 96 years old, and decided to sell now while he knew what the estate tax law was, so he could know how much he was giving his beneficiaries instead of waiting until he died and perhaps having to pay more in estate taxes. It's the only building of its size and type that was ever built on the sand, adjacent to a public beach, and in probably one of the most accessible locations to all of Playa Vista, which is a huge development on the former Howard Hughes property, which is now part of the core of Silicon Beach. And the rents are far below market because by the time this guy got to 96, all he cared about was keeping his units occupied. And this building could never be replaced because it was built 4 years before the Coastal Act, which precludes this type of development. So our plan with this is so simple. I mean, we own it. The rents are below market, the rents will go up, the property will do well, and we might convert it to stock cooperatives. And finally, there's one other project that we bought in West Hollywood, which is a new development deal above the Sunset Strip, which is world famous, and across the street from a brand new to be built Mandarin Hotel, which is currently in pre-development. And this project already has all of the permits and entitlements for construction from the city of West Hollywood, which took 9 years. We stepped into it after the entitlements were in place. So, in a nutshell, what we're offering is something that's older than me and older than all of us. I mean, it's real estate. It's been around a long time. It's the sport of kings. It's for wealthy people generally. Most people have never been able to get into it. We offer it, and we offer you a tangible interest. You invest, you own a piece of the buildings instead of investing in a REIT, which is, you don't own anything except a tradable share, which may or may not pay you a dividend, gives you no tangible value. Or if you're lucky enough to know somebody to invest with, you know, as the world has been since the laws changed in '33, very few people have access to this type of opportunity. And finally, and you know, without having to emphasize it too much, there are very, very few sponsors that are actually out there today that have this quality and this track record. And as I said earlier when we first started this, we've never had a loss. And our returns have been in excess of 20% per year on average for more than 40 years. Thank you.
Excellent job, Lawrence. You could tell you're a true expert in your field. And there's a lot of questions already starting to come in. And I want to just let everybody know, too, that we did just launch a poll survey to see how we're doing. And so continue to fill that out. But as the questions are coming in here, Lawrence, I appreciate you coming in. Also, just short notice and changing your schedule. I know you're a busy executive, and I really appreciate your flexibility at such short notice. The first question I want to put it from an anonymous attendee that wants to understand why does Christina take a long-term investment strategy on real estate?
Well, it's very simple. Our philosophy is if you have the lucky opportunity to buy great real estate, there's no reason why you would ever sell it. Because real estate rewards you for holding it if you happen to have the right location and the right sponsor. So that is not to say that we're going to hold a property for 20 or 30 years. What it means is that to extract the maximum value out of real estate in a market where there's no supply and increasing demand, you simply want to keep that property, extract value, extract as much as you can, hold it until the right time and somebody knocks on your door and says, I want to buy that property at a price that makes no sense to you, but if it makes sense to them, you sell it to them. It's precious. It's like buying a Birkin bag at Hermes or buying a D Flawless 14-karat diamond at Cartier. That's our real estate. That's what we deal with. And so we just hold it until somebody ultimately says, I'll pay a number that doesn't make sense.
Excellent job, Lawrence. I also, you start off by saying that real estate is boring. I would disagree with you. I don't think real estate's boring. I know I came from that background as well. I spent 15 years in the industry, and I don't think it's a boring. In fact, institutional investors don't think it's boring either. They put at least 8% of their portfolio in real estate, so it's definitely a part of their investment strategy. It's definitely a part of a lot of investment strategies out there. So insurance companies and pension funds and so forth. But let me get to some other questions here. This one really relates more to leverage. So a question from Meng. When you purchase properties, do you work with banks? In other words, how much equity do you put in? And so are you using leverage or financing to structure these deals as well?
Well, yes, it's a very good question. And the amount of money that's borrowed and the price of money and the availability of money are all tied together as applied to the actual asset that's being acquired. And so leverage is a fantastic thing. Without leverage, real estate would not be fun, and without tax benefits, it would not be fun. But the combined of those things is what really drives valuation and ultimately profitability. Right now, money's cheap, but so real estate's expensive, and it's always expensive in our region. So on acquisition, typically, leverage is somewhere in the range of 35 to maybe 50%. That's been historic at least since 1978. I don't think it's ever going to change. But over time, as real estate in the portfolio grows in value because of increased net operating income, if interest rates are flexible, beneficially reduced from what your existing debt is, we have fantastic long-term relationships with lenders. So what we do is we stay with our lenders. We're a K-Reg top-tier borrower at Chase, for example. So we're a phone call to Jamie Dimon, that kind of relationship. And so what we do, and remember, lending is a business, and it's a two-way street. So lenders make money by putting money out and getting paid interest. And if they have great collateral, which is what we have, that's the holy dream for lenders. So what we do is, we borrow money to buy an asset, and after a few years, that real estate is worth more and the income is higher. The bank will come to us and say, hey, do you want a few more million on that one? And so we use leverage very, very effectively to be able to extract capital on a non-taxable basis so we can distribute it to our investors.
Excellent. Lawrence, I have another question here coming in from Anonymous. And I think I've heard you talk about this too before. We all talk about in real estate, it's about location, location, location. And I've heard you talk before about timing, and now we have a question from the attendees. It's anonymous that says, how are you finding these opportunities? Are you in the money from day one when you find these, or do you have some value add approach?
Well, actually, in this firm, we discount the term value add. Value add to us implies buy it at retail and figure out a way to make it worth more money. Our strategy and our philosophy is we're a value bot. If there isn't a death, a divorce, a bankruptcy, a partnership dissolution, or some other material stress where we can buy a property at least 20% below our estimate of market value, we don't even buy it. And the reason to buy it in the money is we can't control markets. And so if we're in the money by 20% and the market goes down 20%, at least we still have our equity. So that should be a pretty direct answer.
Excellent. Thanks, Lawrence. We have some other questions here too, maybe more about the history of Christina and how many transactions have you executed? What's your average size on a transaction, on a building purchase?
Well, historically, we've completed hundreds of transactions on the west side. We could send a map out, would be just cluttered with flags on properties and projects that we've owned. We were the largest owners of Westwood Village, south of UCLA. We created the Montana Avenue Shopping District. We were the largest owners of retail in South Beverly Hills. We've owned massive amounts of high-end apartments. So, in terms of our track record and experience, we have a certain velocity, but people call us to buy their property more than we're dealing with, looking to buy things. Deals come to us. We just got off the phone with a fantastic opportunity on a deal where a foreign investor is unable to get their money to the U.S. to close, and we're going to pick this deal up that earns a current 12% cash-on-cash return, and if we do it. So deals come to us because of our longevity and our status and our reputation in the industry here, focused exclusively on the west side.
Excellent. I think we have time for one more question, and it really relates to appropriate for timing of where we are in the market today because of COVID. And so how does COVID affect your revenue streams on these properties, or is there any effect of COVID to your portfolio?
Absolutely. Absolutely, there's an effect. Because right now, it's very challenging to rent for two reasons. One, demand is down because offices and businesses are just closed. All of our office buildings on the west side are completely empty. People are working from home. And if people don't need to be near the office, they don't need to rent apartments. So, number two is retail. Retail stores are ordered closed since March off and on. They're hurting and they're unable to pay rent. And under the current emergency moratoriums here, tenants don't have to pay rent. All they have to do is throw their arms up in the air and say, COVID-19, I can't pay. You cannot raise rents under the emergency ordinance. You cannot evict tenants for any real reason under the ordinance. So yes, there's a material effect. How is it affecting our portfolio? Yeah, not so bad. Because we have longer-term tenant relationships on our portfolio. On one particular massive property that we own, we wanted the tenants to leave sooner than their leases expired because we're doing a full project renovation on one of the most exclusive resident or retail streets. So we're having effects mostly positive, some negative, and what we choose to do in this marketplace is not rent to new tenants during the moratorium because we're not stupid enough to take the risk of allowing a tenant to move in and the very next day say, COVID-19, I don't have to pay. So you have a lot of stress in the system, you have a lot of people that are impacted, and you have a lot of gamers. And our real estate's just too valuable. We have apartment units that are worth $1 million a unit. For $1 million, I could buy 500 units in like Houston. So we're not stupid. We're not going to give $1 million unit to somebody that's going to pay $4,500 a month and then not pay us the next month. And we're very, very substantially liquid, and we have tremendous access to capital and debt, and short-term debt to finance ourselves. So we're just kind of hanging out and letting the cloud pass over us. So, but in the meantime, there are others that are experiencing distress, and we're hoping, not negatively, we don't want them to lose their properties, but we have relationships with a dozen banks that have a footprint in the West Side, and we're watching all those deferrals. And sooner or later, the federal government's going to smack these banks, and they're going to have to call those loans in, and we'll be right there if it's a good deal.